financing contracts. So this is different than anything else we've talked about because this is not actually a loan at all. Everything else we've talked about is a loan where a bank is lending money and we're repaying that. Owner financing contracts is different. We have a buyer and a seller. We have a purchase situation going on, but the buyer can't get financing. They went to the lender and they don't qualify, they don't have the down payment, they don't have the credit worthiness, whatever. They can't get a loan, but they want a house. They might find a seller that is willing to finance that for them. And by that, what I mean is that instead of the buyer going out and getting a mortgage, the buyer is just making payments to the seller. And it would be similar to a traditional mortgage. It has an interest rate and a payment schedule and all that stuff. So it's similar to a mortgage payment. It's not rent. It does include a principal and interest portion of the payment, maybe taxes, maybe insurance. There's all variations of that. So it's a mortgage payment of a sort, but the buyer is not paying that payment to a lender. They're paying it to the seller. So they're paying this house off to the seller over time. So there's a lot of risk in this, as you can imagine, both for the buyer and the seller, because one of the concerns for the buyer, what if the seller has a mortgage that they're paying on? The seller has a mortgage for $800 a month. This buyer's buying this home for $1,000 a month. So to the seller, this is a good deal maybe. I'm getting an extra couple $100 a month. The buyer's paying me a mortgage. They're paying my mortgage for me, and I'm getting a couple $100 extra bucks. Not a bad deal. Until I lose my job, and I don't have as much money, and I'm getting $1,000 a month from that buyer. It's not my home anymore. I don't live there anymore. It's their problem. I'm just going to take their $1,000 and I'm going to go spend on my own stuff. I'm not going to pay my mortgage anymore. This buyer has been paying their mortgage. They're doing the right thing. The seller's getting that money and they're spending it, but they're not paying their debt. And so that seller's mortgage company is going to file foreclosure and take that home away, and that buyer's paid all that money into the home and gets nothing out of it. So there's a bunch of risk in that. There's also risk for the seller too, because again, what if the buyer stops making payments? Well, depending on what type of owner financing we're getting into, there's two different types. There's a land contract and a purchase money mortgage. In the purchase money mortgage, the seller has to go through foreclosure to get that buyer out of there. So again, even though there's not a mortgage, a traditional mortgage, in order to get that buyer out of the seller's home, if it's a purchase money mortgage, the seller has to go through foreclosure. We kind of talked about that on Monday night too. That it's not fun. It's not easy. It's not quick. This buyer might be able to stay in that home for 6, 9, 12 months while it's going through this foreclosure process. And all the time the buyer isn't paying any money. Bless you. So the seller is royally getting screwed here. Bless you. So there's pros and cons to this. We have seen some benefits of this, especially during times like right during the recession. This was very common during the recession because there were many people that could not qualify for a mortgage for one reason or another. Whether there was not a loan program or they didn't have the down payment or whatever. So land contracts were somewhat, or rather owner financing specifically, was somewhat common. I'm a seller and I'm trying to sell my home and I can't sell it to save my life. There's nobody out there that can buy. There's nobody out there that can get a mortgage. Maybe I'll consider a land contract. So that was very popular back then. We don't see this a lot now. Do see it every once in a while, but not very often. Another variation of this that I don't see very often either, but we still see it on occasion, is something called a seller carryback, which is again an owner-based finance. What makes a seller carryback though different is that there are two mortgages that are taking place. So we have a buyer, let's put some numbers to this. Let's say that the home is being sold for $100,000. And they can find a lender, a traditional lender, that will give them, excuse me, pardon me, they can find a traditional lender that will loan them $80,000. So they can come up with some of the money from a lender. Trouble is, buyer doesn't have $20,000. They don't have the 20% down payment. Maybe they only have $5,000. So they can borrow 80, they've got $5,000 of their own money, so they've got $85,000. I still need 15 though. In some cases, the seller will do an owner carryback or seller carryback, where they will give the person a mortgage, if you will, to say that just pay us the $15,000 off monthly. Pay us your loan. We aren't loaning you $15,000, but you're paying us back the 15. So make payments every month, and again, depending on the terms, you'll pay it off eventually. So there is the traditional mortgage that we've talked about for the $80,000. There's a little bit of a down payment, and then there's that seller carryback for the balance, the difference. So we see those on occasion too. I don't know why, but I just want to point this out to you too. At the very bottom of 295, you may see the terms vendor and vendee. Those are at the very bottom paragraph. It's the second line from the bottom. I would highlight those because it's very likely that you will see those terms again. A vendor and a vendee are always tied to a land contract, seller financing, any type of private mortgage type thing like this. Where we're talking about an owner carryback or a land contract or a purchase money mortgage. The vendor is the seller, the vendee is the buyer in a land contract.